Hello. Welcome back to the channel. Today, we're exploring a hot topic that's been generating a lot of buzz. Bitcoin. Specifically, we're diving into why many of the rich, wealthy individuals and institutions are hesitant to invest in Bitcoin, despite its meteoric rise and the potential for huge gains. If you've ever wondered why the rich often avoid this digital currency, stay tuned as we explore the 7 key things behind their reluctance. Thing number 1. High volatility and risk aversion. Bitcoin is infamous for its extreme price volatility. From dramatic spikes to sudden plummets, the cryptocurrency market is unpredictable and often erratic. Wealthy investors, who typically prioritize the preservation of their capital, are generally risk-averse. They tend to favor investments that offer steady, reliable returns over those with high volatility and the potential for substantial losses. The wild price swings of Bitcoin can be unsettling for those who have spent years or even decades building their wealth. Thing number 2. Regulatory uncertainty. The regulatory environment surrounding cryptocurrencies, including Bitcoin, is still in flux. Different countries have varying rules, and new regulations can be introduced with little warning. Wealthy investors prefer markets with clear, stable regulatory frameworks that protect their investments. The uncertainty and potential for regulatory crackdowns make Bitcoin a less attractive option. Thing number 3. Security concerns and risk of theft. Bitcoin's digital nature makes it a target for hackers. Despite advancements in security, the risk of theft and hacking remains a significant concern. Wealthy individuals and institutions often require a high level of security for their assets, and the numerous high-profile security breaches in the cryptocurrency space are a major deterrent. Thing number 4. Lack of intrinsic value and tangibility. Bitcoin does not generate income, pay dividends, or have any physical presence. Its value is largely based on market perception and demand. This lack of intrinsic value can make it difficult for traditional investors to justify including Bitcoin in their portfolios. Wealthy investors often prefer assets that have tangible value or generate regular income, such as real estate, stocks, or bonds. Thing number 5. Complex tax implications. The tax treatment of Bitcoin varies widely and can be complicated. In many jurisdictions, every transaction involving Bitcoin needs to be reported, and capital gains taxes may apply. This creates an administrative burden and potential tax liabilities that can deter wealthy individuals from investing in Bitcoin. Thing number 6. Market manipulation and lack of transparency. The relatively low market capitalization of Bitcoin, compared to other financial markets, makes it susceptible to manipulation by large holders, often referred to as whales. This potential for market manipulation adds another layer of risk and unpredictability, making Bitcoin less appealing to wealthy investors who value transparency and fair market conditions. For example, instances of pump and dump schemes, where the price of Bitcoin is artificially inflated and then sold off for profit, can cause significant price fluctuations and create an unstable investment environment. Wealthy investors prefer markets where prices are more stable and less prone to manipulation. Thing number 7. Environmental impact. Bitcoin mining consumes a significant amount of energy, leading to environmental concerns. The process of validating transactions and securing the network requires substantial computational power, which often relies on non-renewable energy sources. Environmentally conscious investors may avoid Bitcoin due to its large carbon footprint. For example, the energy consumption of Bitcoin mining has been compared to that of entire countries, raising concerns about its sustainability. For investors who prioritize environmentally friendly and sustainable investments, the negative environmental impact of Bitcoin mining is a significant deterrent. While Bitcoin has attracted a lot of attention and some high-profile endorsements, many wealthy individuals and institutions remain cautious. Their reluctance is rooted in the cryptocurrency's volatility, regulatory uncertainties, security risks, lack of intrinsic value, complex tax implications, potential for market manipulation, and environmental impact. As the cryptocurrency landscape continues to evolve, it will be interesting to see if these attitudes shift and if Bitcoin gains greater acceptance among the world's wealthiest investors. For now, though, these 7 reasons help explain why the rich may be keeping Bitcoin at arm's length. Thank you for watching. If you found this video informative, please like, subscribe, and hit the notification bell for more insightful content on finance and investing. Let us know in the comments below your thoughts on Bitcoin and whether you think the rich are missing out or making a smart decision.